Hi everyone, welcome to your chapter on internal controls and cash. So if you see the beginning, the header of this chapter, Sarbanes-Oxley, is the Sarbanes-Oxley Act. Internal controls were always important, of course, but a much greater focus was put on them after some events in the early 2000s, and those events brought on the creation of the Sarbanes-Oxley Act. So before we talk about what internal controls really are and get a better understanding of those, I think it's important to understand why they became such an important thing. Not that they weren't always important, it's just that we didn't take them quite as seriously as we were forced to as accountants. All right, so with Sarbanes-Oxley Act, if you remember, we talked about Enron a little bit. Enron was a huge fraudulent, I hate to say company, but I mean the company wasn't fraudulent. They did things. It's just their accounting practices were abysmal. And the problem there was that a lot of people lost a lot of money. And we're going to talk about the specifics of that in a moment. But right on the heels of Enron, so imagine you have this major financial collapse, right, of this huge company. Right on the heels of that, there was a company called WorldCom that also got themselves in trouble. They had miscategorized expenses as assets. So if you think about it, you can take the cost of an asset, some sort of major purchase, right, buildings, whatever, refurbishment, and you would be debiting that. So you would debit it as an expense if it was just for the period, or you would debit it as an asset, right, on your books, because maybe, you know, a new building or something, of course. And then the idea is that if it was put as an asset on your books, then you would probably depreciate that asset over time. Well, WorldCom had a whole bunch of expenses that they should have been expensing, which would have brought down their net income. But instead of expensing them directly in the one period, because that was the accounting treatment for those items, instead of expensing them, what they did was they capitalized them and made them assets on the balance sheet. So what that did was it spread out the costs over a long period of time, because then the expense doesn't hit the income statement, except over, you know, the years of depreciation. So they, I hate to say got caught, but it was a huge accounting error. And it should have been caught. It should have been caught for a few years that they were doing it. And since it wasn't caught, and it was so significant or material, that it required a full restatement to the financial statements. And it was like to the tune of billions. So it was a really big deal as well. And then right on the heels of that, I mean, we're talking within a couple of years here, like 2-3 years, was Tyco. Tyco was, unfortunately, a New Jersey-based company. I don't remember what they did. I don't know why my brain says toys, but that maybe I might just be making that up. But anyway, Tyco is a company, and the owner of the company, or the CEO, I'm not sure if the CEO or the president, had been using the company as his personal piggy bank for like decades. All right, and that also probably should have been caught by the auditors somewhere along the way, and it wasn't. That's an interesting case, so if you ever want to look that one up, well, either of them really, but Tyco is kind of funny, because, I mean, not funny, I can't believe that he did that kind of funny. He did things like, you know, had, you know, $5,000 shower curtains, and he had thrown a party for his, you know, a second or third wife on a boat in the Mediterranean, and had Jimmy Buffett singing for him and, you know, a couple hundred of his closest friends on a yacht. And that was a business expense. So, point was, right, the point to all of that is that, you know, it shook investor confidence. Okay, so let's just like look at Enron specifically, because that was the biggest and the first major one. And the auditors were way involved. So the idea is, right, Enron, they kind of almost made up their own gap. They recognized revenue before they were supposed to. There's even a movie. It's called The Smartest Guys in the Room, and it's really interesting. If anybody, you know, it does have some parts that you need to be sensitive about. There's like a 10-second nude scene maybe in a strip club in it, and there's also suicide right at the beginning. Not that you see anything, but regardless, just wanted to let you know that in case you were interested in watching the movie. But it's called The Smartest Guys in the Room, and it's a really great, well done documentary on the Enron collapse. So they provided bad financial information to the investors and creditors, right? Your stakeholders, the people that are, you know, investing people's money and such. And the auditors were supposed to be checking that they should have caught that bad financial information. I mean, their job is to protect the public. That's why they're certified public accountants. They didn't do that, though, because Enron was the ones paying them. They were not even paying them directly, not like salary, but the idea is that they were in collusion with them. The partners that were in charge of auditing the company were also part of the fraudulency. Right? They were making money too. So with these three things, Enron, WorldCom, and Tyco, people didn't want to invest their money. They're like, how can we, all these auditors, these accounting firms are supposed to be in here putting their seal of approval on the financial statements so that I can rely on them. If I can't rely on them, how can I give them money? How can we invest with any sort of certainty? Every financial statement out there could be bogus. So what was put into play was the Sarbanes-Oxley Act of 2002. I want to say Sarbanes and Oxley were the men who put it forward. I want to say they're I don't remember my business law of my tiers, but they were two senators, or I think senators, that put it forward, and they were Sarbanes and Oxley were their last names. But they put forward this act, and the idea was that before this, internal controls were just part of a regular financial statement audit, right? Every public company has to have their financial statements audited. Well, we did it. It was part of it. I mean, I worked on jobs where I was the auditor and I was checking internal controls, but it was really, the focus wasn't there. It wasn't a high priority. The high priority was the financial statements and the numbers. But, internal controls are put into place so that, you're safeguarding the assets of a company. This internal controls are the checks and balances, if you will, of a business. And we'll get into specifically what those are in a minute. But Sarbanes-Oxley Act introduced a bunch of things. It introduced a required financial statement audit. I take that back. They introduced a required internal control audit in addition to the regular financial statement audit. So now instead of just this big financial statement audit, they have a big internal control audit and a big financial statement audit. What does that mean for accountants? More jobs. But it also meant greater focus on the checks and balances in the company. All right, so it introduced a bunch of new rules, the Sarbanes-Oxley Act. The idea was to try to prevent this type of fraud with the auditors being in on it and Enron being allowed to put out bad financial information, as well as WorldCom, Tyco, any company. So a couple of things they introduced is they introduced jail time for executives. Before this, that wasn't really much of a thing. They had jail time up to 25 years in prison if they were part of these efforts. They also put into place the PCAOB, which is the Public Companies Accounting and Oversight Board, if I remember correctly. And the idea is they're almost like they're the watchdog group over the accounting firms. Before this, the accounting firms were just, we are ethical, we do our job, and, you can trust us. And what the big companies did is they actually did peer review audits of each other. So they checked a couple of each other's audits and said, yes, they are doing their audits well. Yes, they are doing their audits well, and so on. So they checked each other. They policed each other. But obviously they weren't doing that great a job. So they put in place an oversight board. So this public PCAOB, what they do is they are the ones that then check all the different accounting firms and make sure that they are doing their job properly. And they put in, as I said, an internal control audit, a required internal control audit. So not only do you have to check the financial statements, they have to check the internal controls as well of a company that they're auditing. Okay. So the objective, what is internal control? Like I said before, it's the checks and balances of a company, making sure that you have, you're trying to safeguard your assets. You're trying to make sure that, money's not being stolen, inventory is not being lost, revenues aren't being reported improperly. So the idea is you're safeguarding your assets from things like theft or damage and so on. You're making sure that accounting information is good, that you're producing good financial statements that can be relied on. You're following GAAP properly, but in a not so much looking at the financial side of things, like the numbers, but looking at the processes that are put into place to make sure that revenues are getting reported when they're earned, not before they're earned, things like that. You're making sure that the rules are being followed. Ensure that employees follow company policies, right? You're meeting the goals of the company, and you're using your resources wisely. Okay, so all these things, read about the internal controls in your chapter to get a better understanding of these things. One of the most important things, element of internal control, is the environment that they're in, right? If your environment is make money at all costs, right? If that's the message coming down from up above, top management, then you're kind of inclined to cut corners, and that's not a great thing. So the management's attitude, their philosophy, that's called the control environment, right? What's the environment of the people that are leading the show? Okay. Some of the personnel practices you might put into place to make sure that you do wind up with good employees, right? Maybe you perform background checks on employees. Let me give you an idea real quick. When I went back to work at the accounting firm for a few years, just, while I was teaching, just to kind of keep my hands in the game, I went back for several busy seasons, 3 or 4, I think. And one of the things they did, which they hadn't done when I graduated, or at least not that I knew they did it, when I graduated from college, I went straight to work for EY. Then I was teaching, and then I went back a little bit just to, like I said, keep my hands in the game. What they did was they performed a background check on me because I'm dealing with people's sensitive financial information. I don't have a thing, not one thing, not one tiny, other than like maybe a ticket of driving with a cell phone in my hand, or a parking ticket, there's literally nothing in my background that's negative. This was a 3-page background check, okay? They checked me every way from Sunday to make sure, my credit reports, had I ever been in, court, was my name anywhere? And one thing that was nice is they said at the end, there were some positive things about this, this, and this, so they found some positive things about me in the news, because I was the advisor to the Honor Society on campus, but they didn't find anything negative, but it was thorough, all right? So background checks, if you have people dealing with sensitive information or in a position of importance, you want them to make sure that their background checks are clean, and not just these little simple ones, right? Criminal, you check the employers, you check people's credit. You want to do drug tests, you check their social media now for sure, right? That's a thing, absolutely a thing. So make sure that's locked down. You want to also train your employees. You want to make sure that they are following the processes that you've put in place. You don't want them saying, I didn't bother doing that because I didn't think it was important. No, you want them to understand what they're doing and why it's important. You want to evaluate those employees regularly, and you want to make sure that you have a code of ethics in your business, because you want something to follow so that you can point to and say, these are our values, right, in the company. Okay, so with that, I'm going to pause. See you in a minute.